Here is a question worth sitting with this Saturday morning. What does it take to make the most powerful financial institutions in the world even more profitable? Apparently, all it requires is ordinary people continuing to swipe their cards, pay their mortgages, and take out loans. As of today, the 11th of July, 2026, Wall Street is bracing itself for what analysts widely expect to be a bumper earnings season for America's biggest banks. The so-called profit engines, think JPMorgan Chase, Bank of America, Wells Fargo, Goldman Sachs, and Citigroup, are collectively anticipated to post results that will likely turn heads across global financial markets. The catalyst is not some exotic financial instrument or a windfall from speculative trading alone. It is something far more fundamental. Main Street, the everyday American consumer, has simply refused to stop spending. And that resilience, as we will explore today, is doing more to pad bank balance sheets than perhaps any other single factor right now. Earnings season for the major United States banks traditionally kicks off in the second week of July, and today, Saturday, the 11th of July, 2026, we are right at that threshold. The largest institutions are expected to begin reporting their second quarter results within days, and the mood heading into those announcements is decidedly optimistic. Net interest income, which is the money banks earn from the difference between what they charge borrowers and what they pay depositors, has remained elevated due to an interest rate environment that, while it has shifted from its 2023 and 2024 peaks, is still yielding healthy margins for lenders. Loan books have held up remarkably well. Consumer credit demand, for car loans, personal loans, home equity lines, has not collapsed in the way some economists feared it might. Investment banking divisions, which were sluggish through parts of 2024 and 2025, have also shown signs of recovery. Put all of that together and you get precisely the conditions in which big bank profit engines roar. Let us talk about the consumer, because this is where the story genuinely begins. Main Street spending, that is, everyday household expenditure on goods, services, travel, dining, and retail, has proved to be the backbone of the United States economy throughout 2026, and it is directly reflected in bank revenues. Credit card transaction volumes at the major institutions have remained robust, and crucially, delinquency rates, while they have ticked up modestly from historic lows, have not surged to levels that would signal widespread consumer distress. People are spending, and largely, they are managing to keep up with their repayments. This matters enormously to banks because card fees, interchange revenue, and interest on revolving balances all flow directly into their income statements. When the consumer is healthy, the bank is healthy. When the consumer keeps spending despite higher living costs and persistent geopolitical uncertainty, as has been the case through the first half of 2026, banks find themselves sitting in an unusually comfortable position heading into results. Not every financial institution benefits equally from this environment, and it is worth being precise about why the very largest banks, the so-called systemically important financial institutions, are particularly well placed right now. First, their scale allows them to diversify revenue across consumer banking, corporate lending, wealth management, and investment banking simultaneously. When one division softens, another can compensate. Second, their deposit bases are vast, which means their cost of funding remains relatively controlled even when interest rates fluctuate. Third, the investment banking arms of institutions such as Goldman Sachs and Morgan Stanley have been buoyed by a gradual reopening of merger and acquisition activity and a recovery in capital markets issuance, companies raising equity and debt, which had been subdued for much of 2023 through to mid-2025. Finally, trading divisions have benefited from periods of market volatility, including the volatility associated with geopolitical tensions in the Middle East earlier in 2026, which generated significant client activity and fee income. To understand why expectations are so elevated right now, you need to look at what shifted over the past several months. The geopolitical turbulence earlier in 2026, centered in part on conflict in the Middle East, initially rattled equity markets, but stocks recovered sharply and moved back towards record highs with surprising speed. That recovery was itself a signal of underlying economic confidence. Simultaneously, fears about a sharp consumer slowdown that had dominated economic commentary through late 2025 simply did not materialize at the scale many predicted. Retail spending data continued to come in at levels that exceeded more pessimistic forecasts. Employment held firm across most major sectors. Against that backdrop, the Federal Reserve's rate path became clearer, giving banks more predictability for their forward planning. What this has produced is a financial environment in which credit losses have stayed manageable, revenue streams have been solid, and the macro tailwinds that punished bank margins in lower rate years have largely been replaced by a more favorable equilibrium. For investors watching this earnings season, the implications are significant and immediate. Bank stocks have been among the stronger performers in equity markets heading into July 2026, reflecting the market's growing confidence that reported results will validate the optimism. A strong set of earnings from even 2 or 3 of the major institutions next week could provide a meaningful lift to the broader S&P 500, given the financial sector's weight in the index. For retail investors, the relevance extends beyond simply owning bank shares. Strong bank earnings are often read as a leading indicator of broader economic health. If banks are doing well, it generally means businesses and consumers are borrowing, spending, and investing. It is a signal, not a guarantee, but it is a meaningful one. Fund managers will be watching closely not just the headline profit figures but the commentary from chief executives about what they are seeing on the ground, consumer behavior, loan demand trends, and any early signs of credit stress that might emerge in the second half of the year. No earnings season exists without risk, and it would be incomplete not to address the headwinds that could temper even a strong set of results. The most significant concern surrounds credit quality. Consumer spending has been resilient, but spending on credit carries an implicit risk. If employment softens, debt service burdens could rise quickly and default rates could follow. There is also the question of deposit costs. Banks have had to compete more aggressively for deposits in this rate environment, which can compress net interest margins even when headline rates appear favorable. Regulatory scrutiny of the big banks has not diminished, and capital requirement discussions continue to create uncertainty about how freely banks can return capital to shareholders. Geopolitical risk remains live, particularly given ongoing instability in the Middle East, which, while it has not derailed markets so far in 2026, retains the capacity to generate sudden volatility. Investors and analysts will be listening carefully to management guidance on each of these fronts. Looking at the near-term picture as of today, the consensus view is that the second half of 2026 will remain broadly supportive for big bank earnings, provided the consumer does not deteriorate sharply. The key variables to watch are employment data, retail spending figures, and any shift in Federal Reserve policy language. If consumer spending holds at or near current levels through the third quarter, banks are positioned to post another round of solid results when they report again in October. The investment banking pipeline, which has been rebuilding after a prolonged slowdown, represents genuine upside if deal activity continues to accelerate. The caveat, as always, is that much of this optimism is already priced into bank shares, which means any disappointment, even a slight miss on revenue or a cautious forward guidance statement, could trigger a sharp negative reaction. In short, the profit engines are expected to roar, but the market will be listening for any falter in the note. So here's what to carry away from today's breakdown. The big bank earnings season opening this week in July 2026 is more than a Wall Street event. It is a real-time report card on the health of the American economy as felt by ordinary people. The fact that Main Street consumers have kept spending, kept borrowing, and largely kept repaying is what underpins the optimism surrounding these results. For anyone with savings, a pension, or an investment portfolio, strong bank earnings season matters. It signals an economy that, for now, is finding its footing despite geopolitical turbulence, persistent inflation pressures, and elevated interest rates. Watch the results as they land over the coming days. Pay attention not just to the profit numbers but to what the chief executives of these institutions say about the months ahead. That commentary will tell you far more about where the economy is genuinely headed than any single data point. And as always, the story of Wall Street begins and ends on Main Street.